Good afternoon, everyone, and welcome to the first day of AFSIC. My name is Alfonso Campo, and I'm the Senior Manager, Stakeholder Engagement and Member Services at AFCA, the African Private Capital Association. As you might know, AFCA is the Pan-African industry body promoting and enabling private investment across the continent. Our mission is to support private capital ecosystems by providing access to data and analytics, thought leadership, professional development courses, and networking opportunities. It's a pleasure to be opening chair for AFSIC 2024. Prior to starting this session, I would like to thank, on behalf of the AFSIC organizers, the sponsors for their support, and also everyone else for making the effort to come here today. I have been asked to remind you that you can book meetings using the app, the AFSIC event app. If you have not downloaded it, you can scan the QR code on the printed agenda. Also a reminder to review the AFSIC Deal Book to connect with investment opportunities. And finally, a reminder that the Meet African Deal Makers event tonight is ticket only, and it starts at 7:30 p.m. You can find more details on the website. To kick things off this afternoon, we will be discussing investing in Africa's fintech boom. I'm pleased to introduce our moderator, Amanda Kabagambe, partner and head of East Africa at TLG Capital. Amanda is an experienced transaction advisor with over 14 years of expertise in structuring investments and advising on business growth across East Africa. Amanda, the stage is yours.
Thank you, Alfonso. You got my name right. Amanda Kabagambe. Great to see a full room at the beginning of the day. Thanks for coming in. I will introduce the panel and welcome them to the stage. We're joined by Alexander Leach, CEO and co-founder of Curious Finance. It's Curious Finance, so it's Curious Finance. Alexander has worked in West Africa and the USA, starting with mobile financial services, payments, and is now providing debt to African fintechs. You're welcome. We're also joined by Mayur Patel, who I think is a PhD. So I think it's Dr. Mayur Patel, President and Managing Director of mCOPA, the region's largest connected financing platform. Previously, he served as COO for Cassava Fintech, provider of mobile wallet and payment solutions. We are also joined by Dave Van Niekerk. He's a global fintech entrepreneur working across various African markets in microfinance, credit, and financial services. Dave founded MyBucks, a German fintech firm that is listed on the Frankfurt Stock Exchange and has been pivotal in addressing the limitations of traditional banking and advancing financial inclusion across the continent.
Thanks, Mana.
Finally, but in no way the least, Jeremy Kwainu. He was recently named Young FinTech Leader of the Year. Jeremy is an experienced digital finance professional with over a decade of experience in banking and fintech. Jeremy champions initiatives that connect traditional financing institutions with the future of digital finance. He's currently the General Manager for Africa Operations and Partnerships at Jumo. He oversees innovative digital finance strategies across 8 African markets, leading partnerships, operational efficiency, product markets, and capital growth. I must add also that Jeremy has a YouTube channel, so please like and subscribe, okay? So this is our panel today, very balanced in terms of experience, in terms of demographics, but also in terms of markets. We have investors, we have operators, and we have people that have worked on both the investment side and the operation side. So welcome. Getting into the discussion, Africa's fintech sector, as we all know, plays a critical role in driving financial inclusion, fostering innovation, and boosting development. Whilst the opportunity is exciting, investing in this ecosystem comes with unique challenges and regulatory considerations. This panel will explore how investors can mitigate risks and maximize returns in Africa's dynamic fintech landscape. So let's start with the big picture and what it takes to balance profit, purpose, and market realities. Mayur, in building a sustainable fintech business model, what approaches have been most effective in removing barriers to entry and expanding market reach, particularly in regions where access to traditional financial services is limited?
Great. Thank you very much. Nice to be here with everyone. If you're thinking about how to expand the market, make it more available to a broader number of people, you're really actually at your core thinking about business innovation. You know, how can you see something that other people can't see, really? And for us at M-KOPA, our absolute focus, our obsession, is serving the 90% of customers in Africa, 90% of adults in Africa who are employed in the informal economy. These are individuals who are what we call kind of everyday earners, and yet completely locked out, by and large, out of traditional financial services. The story is pretty familiar. You know, existing incumbents can't serve that segment. They're not monthly salary. They don't have a paycheck. They don't have the ability to have guarantors or collateral. There are approaches to try and deploy credit into that on an unsecured basis, but our approach at M-KOPA was to kind of think of it differently. And so the kind of first innovation for us in expanding the market was kind of a product innovation, which was our goal was to figure out how can you get into a broader segment of customers through not an unsecured lending relationship, but by financing the most sought-after piece of hardware in someone's life, which is a smartphone. And so many customers just can't afford $100 for an entry-level smartphone. And so customers can come put down a small deposit and then pay for it in installments over time and get access on a secured basis to something that itself is a money generator for them. So that was the approach to kind of broaden the addressable base. The second was to kind of think about how do you change the mindset around credit and credit innovation when it comes to pricing. And to do that, most traditional financial credit relationships are based on a kind of a bullet payment or a monthly installment. Our shift was to say, no, customers can pay back daily. And so how do you match the way consumers actually earn their money with the way you think about asking for that? So that was the other piece. And then the final innovation for us, and I think it's the case for a lot of businesses who have figured out how you push back the addressable market and make it bigger, is thinking about how you change the distribution model itself. A lot of the customers we choose to serve, they aren't digitally connected. And so you've got to find a way to meet them where they are. And so today, right now, we run one of, if not the largest direct distribution sales forces in Africa, which is 30,000 active monthly selling agents who are going out there onboarding customers and selling to them. The entry product was a smartphone financing solution, a secure-backed credit facility that then we layer on top additional services. So if it's about addressable market, it's like how do you go out there and tackle things to see a segment that previously people said, oh, you can't serve that segment profitably and at scale, and do it differently.
Fantastic. You've touched on addressable market, getting into the market, and of course, tying your collection cycles to income cycles, right? Moving on to investments, valuations, and regulation, over 60% of startup funding in Africa is allocated to the fintech sector. At least $1 billion, $1.5 billion has been invested in Africa's fintech sector. Alexander, from your perspective as a debt investor, how do you view the scalability of fintechs and the current trend of valuations? What key factors do you consider when assessing these opportunities?
Thank you. I think for those who don't know, a big portion of that billion went to M-KOPA, right? We have a big debt facility. So when we think in terms of scalability, right, there's I think a question about the size of the market, right? And then there's another about evaluating those companies. So to take them in order, if we look at sub-Saharan Africa, we estimate that 49% of adults have access to a financial account, a formal financial account. And then we estimate that 8% of adults in that region have access to a formal loan. So it indicates to us that there is a lot of room for growth. At the same time, we do find that in some niche and some segments, there can be saturation. So I would take the example of consumer loans, maybe in Kenya, where one could argue that loans that are under $100, high rate, short term, 30 days, there may be some saturation there. But in general, I think there is a lot of room for growth for fintechs who can do that measurably and in a controlled manner. Now, when we look at it as a debt investor, we we don't take participation into the equity, but it is important for us that our portfolio companies can actually raise equity again in the future, right? So that they can have collateral and can continue raising debt. So we're sensitive to the valuations. And we find that compared to 3 years ago, the pendulum has swung back from what we might have called lofty valuation to actually it being hard for fintechs to raise financing, especially in Series A and later. But that's not a situation that is specific to Africa. It's actually true in all regions, unless you do AI, right? So with that in mind, we think the market will continue to swing back and forth because the VC industry is actually very cyclical. But we do like the present time because it brings back a focus on bottom line and controlled growth, unit economics, which are things that are particularly dear to us as debt investors. There are two things I want to add to that is, one, the VC industry to me has done a fantastic job in Africa of leveling the ground for investors, for entrepreneurs compared to other regions, right? If I think back 15 years ago, if you wanted to work in technology, mass market, like was my case, I ended up working at a telecom operator doing mobile money. That was great, but you didn't get a stake into the equity. And today, if you want to do it, you have access to studios that will provide financing to local entrepreneurs, allow those entrepreneurs to form local teams, and really go after the market and be well-funded for that. We see examples of that with M Studio in Côte d'Ivoire, Future Africa in Nigeria. And that meritocratic approach to entrepreneurship, I find, has really changed the fintech industry in ways that I don't see in a lot of industries on the continent. And so that is fantastic. At the same time, as a debt investor, again, sometimes I see a bit of tension where VCs really want to see growth. And as we talk about lending, growing fast in lending can be very damaging to businesses, right? So there we do find ourselves sometimes on the opposite side on discussions with companies in which we invest, putting controls and wanting to make sure that growth is measured.
Great. Speaking of market size, remittances and cross-border payments have seen strong growth. If I recall correctly, remittances in Africa in 2022 came to about $100 billion. This is definitely a significant market size. Now, Jeremy, Jumo works very closely with mobile network operators who have been central to remittances and payments. What specific innovations or strategies do you see whilst we've sort of achieved country-to-country connection, right? What strategies do you see around rural and urban, bridging the rural and urban divide in remittances?
Okay, thank you for that. So I think it's interesting to observe that the mobile network operators have led the charge when it comes to financial inclusion to a large extent. So if you take it back to 2008 when M-Pesa sort of led the charge, they revolutionized, let's call it the fintech space in Ghana, in Africa, sorry. But the backstory for M-Pesa was that it wasn't initially designed to be that peer-to-peer payment system that we see now. The actual intention was to help microfinance borrowers manage their loan repayments. Then down the line, the customers found utility in sending money across country to the rural and urban areas. And M-Pesa adjusted by adapting, and that's how come we got these mobile money rails. The lesson there is that even though M-Pesa was the one to start it, they were not the one. They are not the biggest mobile money provider in Africa. MTN and Orange have taken that title, and the key there was they figured out the agent network. So I think one of the first things would be that the agent network is one of the best ways to bridge that gap, where you have an individual who's sort of like a standalone operator or bank that gives people the opportunity to get that handshake or that handover between the digital face and then the physical face. So we call it a phygital model. So the agent network where, in countries like Ghana, MTN Mobile Money has such strict guidelines, like you can't walk 200 to 400 meters without meeting an agent. So that really gives people the chance or that utility to meet somebody when they have questions about financial services that are being offered. The next one would be the leveraging of channels that are offline. So the USSD channel, for example, despite the smartphone penetration in Africa, you notice that there's a disproportionate amount of people, at least in our space, who will access a service on USSD versus an app. So if you're an app-based platform, you begin to see that you typically have to have a USSD sort of auxiliary. And The advantage of this is that it works whilst it's offline. So if you're going to the outskirts of the regions, a customer may have a smartphone, but they don't have as much access to the data that is required to activate the service. So you have to tailor your product, or the MNOs have begun to become much better at providing that channel, and you tailor your product to these low data environments. The other one is partnering with local operators. So the MNOs have found the best ways to partner with banks and fintechs such as Jumo so that they can offer services that they themselves could not build in-house. So currently we're partnered with MTN across more than 9 territories, and we serve over 27 million customers across the African continent. But this is not possible without technology that has the velocity, that has the flexibility to be granting the kind of lending and loans that we do. Right? One of the statistics that we like to brag about is that in 2023, in partnership with the MNO, Jumo was able to disburse 56 loans every minute. So that's just 4 loans shy of a loan per second. But that kind of velocity is what is required to be able to serve people at the last mile. And I think the last one would be to think global, so think about the best practices when it comes to tailoring products, but to act local. Understanding the local cultural nuances, the fact that in certain areas, it's always going to be a man who is going to take a person through the financial services, and then try and think how best to tailor your product to suit those things, right? We do lending, for example, and we began to understand that when you give customers a due date, it's only on the due date that they even remember that they have a loan product, regardless of the number of SMSs. So they've requested for sort of like a grace period. So within that grace period is where you see the highest level of repayments. But if you never granted that grace period, you will just see a lot of defaults. So you think global, but you act local. And I think these are some of the things that the MNOs have mastered in trying to bridge the gap between urban, rural engagement.
Amazing, 56 loans every minute. While all of that is exciting, we have realities of, you touched on quality of technology, how flexible it is, right? And how mature different technologies are, especially when you start to integrate with other providers, right? Then of course, network quality, and we have still challenging regulatory frameworks and currency risks. So I want us to move to the risk side of this exciting investment opportunity. Dave, in terms of infrastructure and regulation, what have been the biggest hurdles in terms of seamless border payments that you've experienced, and how can fintechs work with regulators to improve the process?
Cool, thanks, Amanda. So I think it's an interesting space, and I mean, most of us have been exposed to Africa for many years, and we've seen the cost in terms of moving money between the various countries. Still one of the biggest obstacles. You've got a lot of people in various countries that have come in and trying to send money home to their families, and it's a prohibitive cost at the moment. Now, when you look at the infrastructure and the regulation, a lot of the times you're dealing with multiple countries, and each of them have their own financial rules and regulations. I mean, we talk African Union, and we're trying to find systems and ways for the countries to almost harmonize their regulations. And I think that's key to this, is in terms of the infrastructure and the governance that goes with it, African regulators are going to have to find a way to eventually almost be on the same page, because we're applying different rules and different regulations in many of these countries. So I made a couple of notes based on things that we've dealt with. So fragmented financial systems. We've really got a whole lot of ecosystems. We talk about MNOs, we talk about banks, and it's very fragmented. So one of the words I want to leave in your minds is interoperability. Like, no matter what we're doing in the fintech space, both as regulators and as fintech players, these things need to be interoperable. They need to work with each other. Need to be able to move money between the various ecosystems. And I think that's one of the biggest things that we're lacking, and one of the things that frustrates regulators and hurts us from a fintech perspective in terms of the infrastructure. So then we move on to things like basically currency volatility and exchange costs. Think about Africa. We're in an ever-changing space. Every day we've got currency movements between the various markets. If you move money today between South Africa and Zambia, the currency is different from what it is tomorrow. So we're very volatile in terms of currencies, and that makes life difficult. So the future there will come into things like cryptocurrencies and trying to find a way to go into hard currency, stabilize, and then almost bridge that gap between moving between those two currencies. So the volatility between the currency and the exchange costs. And then the other thing is the transaction costs. Like I spoke about it when we started. I still think it's an exorbitant cost at the moment. People on average paying 10% to move money between various regions. So somebody a Zimbabwean in South Africa who's sending money home is losing 10% of his money to send it home. Now, if you think about that in terms of a cost, imagine going to the ATM and you lose 10% of the money you're drawing. So for this person to send money home to a wife or a mom or his children, he's losing 10% of that. And a lot of this comes into the food chain because there's a lot of players involved. You're paying M&O operators, you're paying agents, and there's a variety of intermediaries in the space. And I think that's where going forward, the fintech space and the regulators are going to have to work together. And they will have to find a way through sandboxes, through collaboration, that the fintechs of the world and the regulators almost look for a way to do this that's not going to be overly an overburden on fintechs. And on the consumer, you also got unregulated space where many of these people are in these countries without formal documentation. And they land up sending money home through cash or through these exorbitant charges. So fintech is going to play a large space in that going forward. But regulators are going to almost have to relax it a little bit and play more the sandbox space, give them a little bit more grace to be able to do these things. Now, I always take it back. And an example I'll use is an interesting one. If you think about America, it's one of the most regulated markets in the world now. But in the old days, when somebody got off the ship, they could start a bank. They put a table up, and the guy started taking deposits and giving loans. Nowadays, you want to start a bank, the regulation's going to kill you. The same is happening in the fintech space. So regulators, like in many of the countries we work in, are starting sandboxes, are working with fintechs to try and understand that space. Because there isn't regulation for a lot of this stuff. Some of the stuff we're doing has never even been thought of. So it's a chicken and egg situation in terms of what's coming first. But I think one of the big things there is going to be the fintechs and the regulators sort of working hand in hand. And even if the regulations aren't there, they're going to have to almost embrace that gray area and let it happen. Otherwise, we're never going to bring the cost down for the end user. And that barrier to entry is going to sit there forever. Imagine losing 10% of what you literally have earned every month. So one of the things I would want to do is I'd want to harmonize the regulatory and the fintech environment. I would want fintechs to work closer with the regulators. It's even a case of, we're doing this, we know you don't have regulation, we're going to do it, let's work together on the regulation, let's create a sandbox environment. And if you think of what's happening in Europe and even here in the UK with the FSCA, they're doing a lot more sandbox environments. They're a lot more open and encouraging to letting these spaces happen. Africa's a little bit tougher because regulation and red tape was almost invented and kept there, and their job as the regulator seems to be just to enforce that. So you've got to get them to be a little bit more open-minded. Countries like Kenya, South Africa, even Nigeria, all opening up sandbox environments at the moment. One of the companies we invested in was a company called Exargo. Exargo uses cryptocurrency to move funds across Africa, and they went into a sandbox with the South African Reserve Bank. And Mvelo, which is one of the investors in Capitec, they're one of the shareholders in that company. And somebody like Exargo is able to use crypto to move money where it's in the bank account the next day in a different country. Now, that's a one-day delay. We need to get that down to a 1-hour delay. Because at the end of the day, at the moment, it sometimes takes days for the money to arrive in another country. So those are the frustrations that we sit with.
I think with African regulation, you always ask yourself, what comes first, the innovation or the regulation, right? And that's what innovation is supposed to be. It's supposed to be new thinking. So you can't expect the regulator to be thinking about the new things that you're thinking about, isn't it, right? But I guess the answer is collaboration with the regulators. Yeah. You know, some of the biggest questions we get, of course, is that, you know, our regulators are seen to be behind the market, right? Alex, please add.
Just a second, the point that Dave, you were making. So with, for mobile financial services, so when I was at MTN, we were really stuck with getting approval from central banks, especially in the BCAO space, so French-speaking Africa, as well as Liberia. And Ghana was ahead. And what really unlocked it for us was to take the representative of those respective central banks and have them meet those of other central banks and other countries and hear it from them what they liked, etc. And the part that I found interesting and at the same time funny to be like, that was my first job, and it was to understand what country one central bank was willing to listen about and consider to be a good learning from. And we had to understand who it is that they wanted to learn from, arrange those meetings, etc. That unlocked licensing for the region for us.
And I think that's important. I think the regulators, when they see what the other one is doing, they become the thought leader. Right? So somebody sees what's happening in Ghana or South Africa or even Nigeria, and they go, that sandbox worked well. In fact, it could be copy-paste. Take those sandbox environment sort of regulations and impose them in the country. And if we can get everyone on that same page, and to your point, I think a lot of them are starting to talk to each other, and that's the way they're all going to learn.
Yeah, no.
Cool.
That worked great.
Jeremy, do you want to comment on your recent experience with licensing?
That's a pain point for me.
Painful.
So I was just having a conversation with Mario about that, saying that it's taken us 4 years to secure a license when we were one of the first movers in the territory, simply because some of the things that you've talked about right now just didn't exist. In our case, the innovation moved ahead of regulation, and our biggest task as a company was not focusing on serving customers or bottom line, but it was trying to get the regulator to understand the innovation that they just didn't have the presence of mind to pay attention to. But I think once you begin to understand that the people who work in regulatory offices are just like you and I, just incentivized differently, and you try to tailor your approach to what actually does move them, you begin to see a lot more of that collaboration happening. So the reason why we were able to succeed was because they began to start these sandboxes. We were one of the lucky few that had a central bank that dedicated a department specifically to fintech and innovation, and started doing things like regulatory hackathons and inviting the fintech players in to actually give them the perspective. And after 4 long years of waiting, we finally secured that license, and now we can operate legitimately. But I think it's one of those challenges where with time it's going to get better, but it needs that presence of mind for both regulators and fintechs to work together and try and find middle ground in order to not over-regulate, but also not leave a free field for anybody to just act.
Cool. Alexander, what are the biggest regulatory challenges that you've experienced as you try to invest in African fintechs?
So for us, we'll work with companies that already have reached a certain level of compliance, right? So if you need a license, you already have a license. So I think I can speak to that question with less of a fundamental view on inducing change, but as you come in and deploy capital, the challenges we see, I would put them in 3 buckets. One are inefficiencies. The second one would be anti-business regulation, which of course is a judgment. And then the third one would be the risk of graft, right? So on the first one, inefficiencies, I would, for instance, mention the cost of registering a debenture being the debt that a borrower has with us. We need to register it so we can enforce it if that borrower enters in a situation of default. So it's obviously an essential part of the work. If you go to Uganda, the cost is nominal. If you go to Nigeria, the cost is close to 40 bips on the amount, which objectively doesn't make sense because it's not more expensive for an administration to register a debenture, but that cost, what that means, the cost increases with the size of the debenture, and so that cost is then passed to the end user. In terms of the anti-business regulation, so I'm sure you know by now, but I'm French. We have a tendency to regulate in advance, right? I think you guys are advocating for letting businesses find ways to be efficient, but there is a risk to that. The French, we regulate first. We find that characteristics as sort of been inherited in the French-speaking countries, where there is a lot of regulation on end consumer loans. The principle makes sense, right? It's putting caps on interest rates. I think we can all agree that, at least on principle, it's logical. But it seems that because of that regulation, there is a lot less innovation around lending happening in that region. and it lags behind. I personally would argue that it's now acting against the interest of consumers. So always hard to find the right middle, but there it seems to be the French-speaking countries there have moved are a little bit aggressive there, regulatory-wise. So it's just an example. And then the third one on graft, we've had a lot of debates on my team as to what example can I give here without getting into too much trouble. So I'll give a somewhat famous one where it was MTN in Nigeria, I think 2017. They got served a fine of $5.1 billion. So it's $1,000 per telecom customer who didn't have a full KYC. It's over 100 years of average revenue per user. It cost the job of MTN global CEO, his executive team, local CEO, chief legal officer in country, might be the only person who really was clear. But, and then it was negotiated down to $1.6 billion. But coverage there at the time, there was consensus that international investors got very concerned to see that that level of fine could be levied against a large corporation in the country. So when we look at that, we also have to be careful where we operate.
Great. Jeremy, has this affected your approach to expansion? I think Jumo is in 9 markets, right? And those are definitely 9 different jurisdictions, different regulations on banking, different acts, different finance acts, different central banks, right? How has the regulatory landscape affected your expansion plan?
Yeah, I mean, a large part of your expansion plan of your strategy generally has to include the fact that you're dealing with a very fragmented regulatory environment, right? If you just take even West Africa, the way that the regulatory frameworks exist in Francophone West Africa, Cote d'Ivoire, Benin, is very different from the way it exists in, let's say, Ghana, Nigeria. In one instance, you have a very centralized regulatory framework where the Francophone territories are regulated under the West African Economic Monetary Union, if I'm not mistaken. And then the main regulator is also the Bank for West African States, the BCAO. But there's so much regulation there that it slows down innovation. But if you don't understand the complexities of that regulation, you could get stagnated. But you also have the advantage that you have one centralized authority that you can go to. So if you can break in, then you are basically home free. Whereas you just go right across the border to Ghana and you have a more fragmented sort of regulatory environment. Go to Nigeria and you can have overlapping regulatory institutions where sometimes for the fintech product that you're offering, you don't know if you're regulated by the central bank or the SEC, and even they themselves have conflicting policies that doesn't allow you to go through. So it requires a lot of patience, and it also requires a lot of, I'm trying not to be, it requires you to just be realistic, right? There are certain times when you've gone to a place, let's say Mario went to Nigeria, and the reason why he's not getting the regulatory approval is because you took an Indian guy to Nigeria. It's not going to work, right? If you don't have local representation there, you have no chance, and if you don't understand these realities, you will be fighting a system that is not yet ready to change, and you just have to be cognizant of some of these differences. So we bake it into our strategy in itself. We make sure that we are fully aware of the various nuances for each regulatory environment and regulatory framework, and make sure that we stay as realistic in our execution as possible. But it's a large part of our expansion strategy.
Makes sense. Mayur, given everything, you started by giving us a big picture on what it takes to invest with a purpose and profit and really be targeted, right? Now, given the context that we've experienced so far in terms of market realities, what does it take really to deploy? Conceptualizing is one thing, but what does it take to deploy these innovative fintech solutions while balancing risk and affordability?
Sure. Just for clarity, Jeremy's example was hypothetical, right? We operate in Nigeria. We've got a great business. I'm joking. We have a great business and fully licensed in that market. And then that's right. And I also the regulator loves so the combination. But his point is still valid. You've got to be nuanced in your approach. So how do you think about risk, particularly when you're serving segments that has historically not been addressed? I think the interesting thing is that the shape of risk, and actually often the amplitude of that risk, is quite surprising in ways that doesn't always line up with conventionally how people think about this kind of stuff. So I'll just share with you something about our business which I think kind of shocks people a little bit. And they either think we must be totally mad or geniuses and onto something. So right now, we are onboarding about 1 million customers every 6 months with the largest amount of financial leverage they've ever had in their life. So they put down 25, 30 bucks, and they can get access to, call it $200, an asset worth $200+ or so. That is the most amount of leverage. That 1 million customers we're onboarding, we underwrite 0 of them. Not a single customer at the point of acquisition do we underwrite. People actually think we must be totally barking mad when I tell people that. And the reason for that is, if you took the conventional approach to try and manage risk for that customer segment, you can't see into that segment effectively. And so we've done all of the backtesting in our own existing data against CRB data where it exists. The credit infrastructure is not very advanced in most of our economies. Or even some of the existing telco data, and it's not highly predictive of the repayment performances of those customer bases. So if you've got an environment where the infrastructure for that kind of stuff does not exist, you have to think differently about risk. Because if you took the same approach, you just never serve any of those customer segments. So our approach is no, give a secured asset to someone that they can earn money on and use that, and we have an embedded locking technology in the phone that turns on and off the phone if someone pays or not, and use that as the basis to build up a credit history for customers. Now, if you kind of look at risk in our business, credit risk, if you actually look at repayments over time, it is remarkably stable. You know, even during COVID, when many of us had kind of sleepless nights as to what was going to happen when you've got customers who are running a vegetable stand or a secondhand shoe shop, et cetera, are they going to keep paying for that asset? Repayment rates actually went up. And that was in economies where there was no kind of overall surplus of free capital coming from the government to kind of prop all of that stuff up. So risk is very, very different in those markets. Even when we've had massive election issues or disruption or political violence, et cetera, credit has been absolutely rock solid stable. And that's over $1.5 billion worth of capital deployed to that segment base. So risk is often a bit different than you would otherwise think in some of those markets. The other side of risk is, you know, for consumers, consumer protection and affordability as well. And how do you kind of balance those two when you're growing effectively and fast, et cetera? For us, the innovation on our side, but it's actually when you dig into many businesses, people are thinking about consumer protections in novel and interesting ways, is we let any customer, because we don't underwrite them at the start, they just pass a KYC check, so a basic fraud screen, and then they pay a deposit, and that's the signal. So for those customers who find that they can't keep paying for the product or they have some kind of issue, we let them bring back the asset to us. We refund them their entire full deposit. So they've got an incentive to come out of an arrangement if it's not serving them. And we love that because we have an entire refurbishment capability set as a business where we can put those assets back out into market. So thinking differently about risk is kind of opens up, I think, new ways to address a market that otherwise people just won't serve properly.
Thank you. That's definitely practical and innovative as well. As we start to wrap up, I'd like to ask each of our panelists, starting with Dave, you know, just looking ahead, right? What do you believe are the key trends that will shape the African fintech landscape in the next 10 years? 10 years sounds far, but it's actually, when it comes to technology and innovation and Africa, that's a very, very short time. What trends do you feel will shape the next 10 years?
Thanks, Amanda. Well, I think we have to keep an eye on crypto. I think definitely the solution somewhere in the middle there is to use crypto in terms of remittances. Blockchain and crypto are definitely going to play a role going forward. But the other thing that's going to happen is regulators are going to get more involved. Hopefully they'll learn from each other, to the example that we discussed earlier, where they don't make the same mistakes. We see trends where regulators regulate sometimes quickly and they stifle innovation. I mean, I'm openly outspoken against interest rate caps because what tends to happen is the market adjusts upwards to interest rate caps, not downwards in terms of good payment terms. And the South African market's a good example. They've got a great credit act, but everyone kind of prices at the ceiling. You can borrow cheaper in Botswana than you can in South Africa because there's a ceiling in South Africa, so people charge up at the ceiling. So then you've got to look at the ecosystem. And I think for Africa, that ecosystem of fintechs and the regulators, that needs to come together. Also, the trend that I'm hoping to see is more of the open African trade that we're all talking about happening. and that everybody trying to be on the same page in terms of those regulations. But I think watch this space. I think the fintechs, the banks will be partnering more with fintechs. Regulators will be doing more and more sandboxes with fintechs, hopefully learning from each other. And we have to see cheaper cross-border remittances over the next 10 years, using technology, using mobile network operators, using fintechs. And I think we need to understand that a lot of people move around Africa, both legally and illegally. There's an inflow and outflow of people at all times. And so people are moving money and taking loans and using consumer finance and buying assets and taking handsets no matter where they are and no matter which country they're in. And I think the regulators, to a large extent, are very strong on anti-money laundering, politically exposed people, KYC. At the end of the day, these are clients that are not transferring huge amounts of money. They're not the real risk to society, but they're the ones that need to be serviced. And that's where the opportunities lie in the companies that we're all involved in, that we're dealing with the man on the street, we're dealing with the end user, the consumer, and there's a massive opportunity to treat him better, get him better service, get him more credit, get him better assets, get him into the mainstream ecosystem. And I think fintech is going to do that. So you're going to see a lot more over the next 10 years. But to one of the points you raised earlier, it's almost at the moment like the capital has started to slow down because the execution side of things has been slow. So there's a lot of fintechs putting up their hands saying, I'm here now, give me some money. But actually the capital for these fintechs has slowed down. So we've got to be very careful in that space. So we've got to find the right fintechs, back them, and we've got to work closer with regulators. And I think if we get that right, and in that respect, whether we like it or not, industry will move first. You can say you would like the regulators to move first, like they did in France, but in Africa, and they are definitely, the industry is going to move first, and the regulators are going to play catch-up. And it's as long as they collaborate on playing catch-up, and we don't stifle that innovation, because at the end of the day, it's about helping a billion people across Africa transfer money, make payments, get access to credit, and financial inclusion as a whole. Anyway, long story, but that's my version.
I should have asked Dave last. All right. Alexander, what are your trends to watch in fintech?
I was not advocating for regulation first, right?
No,
I'm a converted.
No. I know
So the trends. So personally, I get very interested when I see businesses that tackle a vertical, go in depth, and like when entrepreneurs go really in depth in a vertical, that would be healthcare or mobility, e-mobility, logistics, movement of goods, and then have a lending use case embedded in it, because lending in general generates cash, right? It can be a profitable business by definition, unlike a lot of startup ideas, I would say. And so I really like when you go deep into a vertical, because it unlocks, I think, larger amounts to be disbursed to the borrowers if you understand well the incentives. So think equipment in clinics, think the rights that one has over goods that are being shipped between borders, and I do find that those are the conversations that I enjoy the most when I meet somebody who really understands that vertical. First, because I learned something, and two, because it unlocks a lot of upside.
All right, thank you. We have 5 minutes.
Yeah.
Dr. Mayur, what are your 10 trends to watch? I've added the doctor this time because we're talking about the next 10 years. And particularly to you, do you see any mergers and acquisitions coming up within the fintech space, or do you expect to see a lot more fintechs coming up, but maybe not necessarily getting to a certain market capitalization, or really getting a certain portion of the market?
Yeah. Look, it's a moment in time where there is definitely going to be more consolidation, right? The time in which there was a lot of capital that was moving into these sectors, in some cases without a lot of kind of forethought, that time is now gone. And there are going to be more consolidation. You're already seeing it now. But I think the kind of general trend is that this will rebound. We're already starting to see that, in fact. And there are a breed of just truly exceptional companies who just happen to be based in Africa. And I think that will play out over time. I mean, to your question about trends and what's happening, I think the big trend that all of us lived through here, which really found huge expression in the fintech space, was the massive transformation around connectivity. So it was a massive connectivity revolution that effectively switched out the bank branch for all sorts of mobile payment rails, mobile money, and we felt that globally, but in Africa we felt that acutely, partly because we didn't have a lot of bank branches. The next trend that I'm excited about personally, and I think again will be felt very acutely in our markets, is if the first revolution was a connectivity revolution, the second revolution we're living through today is an intelligence revolution. And the wave that will come now is not replacing the bank branch, but is finding a way to put the personal banker in the hands of the customer.
In the head.
And that, I think, will have a massive transformation, particularly when you're looking at consumers like ours who just have never interacted with that kind of personalized financial support and service. And so that's a lot of where our investments are going, deep into AI and the analytics behind that to kind of power that side of service. But I think you'll start to see in a 10-year trend more of that emerging.
All right, we're up on time, so I'll just say thank you so much to the panel, and I hope you found this useful.
Thank you.
Thanks, guys.